Hey everyone, welcome back to Expound 100. Let me ask you something. Have you ever checked your investment portfolio and felt your stomach drop? Everything's red, numbers going down, losses piling up. The news is full of words like crash, recession, and market collapse. It feels like everything is falling apart, so what do? Do you panic and sell, buy more? Or just close the app and pretend it doesn't exist? Yes, seriously. While most people panic and lose money, so the real question is, how do they do it, and how can you be one of them? Before we talk about making money, we need to understand why stock markets crash in the first place. One of the biggest is something called a bubble. Eventually, reality kicks in. Investors realize the prices don't make sense and everyone starts selling. That's when prices drop fast. When internet companies were massively overvalued. When the bubble burst, the market crashed hard, wiping out trillions of dollars. When inflation rises and things get expensive, people spend less money. Businesses earn less, profits shrink, and investors lose confidence. On top of that, central banks often raise interest rates to control inflation. Higher rates make borrowing more expensive, which slows down businesses even more. This combination can push the market downward and sometimes even lead to a recession. Then there are unexpected events, what investors call black swan events. These are things no one sees coming, like pandemics, wars, or financial crises. A perfect example is the 2020 COVID-19 crash. These events create panic, and panic leads to massive selling. Now here's something important: stock market crashes are actually normal. The market doesn't move in a straight line upward. Small drops of 5 to 10% happen almost every year. Bigger corrections of 10 to 20% happen every couple of years. They tend to happen once every decade or two. Whether it was the 1987 crash, the 2008 financial crisis, or the COVID-19 crash, the pattern is the same: markets fall, then eventually come back stronger. The people who panic and sell lock in their losses. The people who stay calm and stay invested often come out ahead. Of course, not every situation is identical. If the entire financial system breaks down, banks collapsing, people losing access to money, that's a different story. But in stable economies like the United States, recoveries have been the norm, not the exception. When prices drop, it's natural to feel fear. But selling during a crash often turns temporary losses into permanent ones. If you've invested in strong companies, there's usually no reason to sell just because prices are down. Another common mistake is trying to perfectly time the market. Everyone wants to buy at the absolute lowest point, but the truth is no one consistently gets it right. Instead, smart investors use a strategy called dollar cost averaging. This means investing a fixed amount regularly, regardless of market conditions. When prices are low, you buy more shares. When prices are high, you buy fewer. Over time, this balances out your costs and removes the stress of guessing. Not every stock recovers. During a crash, even great companies go on sale, and that's where real opportunities are. Diversification is another key strategy. Spread your investments across different industries or even different asset types. And then there's FOMO, the fear of missing out. When everyone around you is panicking, it's easy to follow the crowd. But successful investors don't blindly follow trends or headlines. They do their own research and make decisions based on logic, not emotion. There is also a more advanced strategy called short selling, where investors profit when prices fall. But it's extremely risky and not recommended for beginners. It's something to understand, not necessarily something to use right away. At the end of the day, a stock market crash isn't just a threat, it's an opportunity. It separates emotional investors from disciplined ones. While most people panic, smart investors prepare. They stay calm, focus on quality, and think long term. So the next time the market crashes, don't see it as the end, see it as a chance. Because history shows us one thing again and again: markets recover, but only those who stay in the game benefit from it. If you found this helpful and want more content like this, see you in the next video.